All right, everybody, we're going to go ahead and get started. Welcome, everybody. Welcome to the 2023 Year in Review event. And, just like all the rain that's been bearing down on Southern California here, our event is getting off to an inauspicious start. Matt's camera suddenly broke. I'm telling you, he didn't get a bad haircut. He's not wearing a bad suit. He's actually looks really sharp in his suit. He was proud to show you. And his camera has decided to not work. So we apologize for that. Matt, you with us?
Yeah, and I promise I'm not hiding behind the camera. Brad just didn't want to look too bad.
Right. Oh gosh, no. We miss seeing Matt's good smile there. But listen, welcome everybody, and hey, this is one of our favorite traditions that we do. It's one of our favorite things to do with you, to be able to recap the events that happened last year and had an impact on your overall financial plan. Such a pleasure to be part of your journey here. So we really enjoy doing this. A big part of what we try to provide here is the coaching, the education, the empowerment around your finances, so that that way we can help you create peace around the issue of money. And that's something that we're really passionate to do here at Seaside. And with that, let's jump in. So today, Matt and I are going to be your hosts, and you all know Matt. And you know that Matt is a certified financial planner. And what many of you don't know is that Matt earned his certified private wealth advisor designation last year. And this is an advanced designation to help people with strategies around tax savings, wealth enhancement, gifting, and estate planning. So he's not just a pretty face. He's got some brains to go with that good looking smile too. Well done, Matt. Congratulations.
Thank you. And it's all just to help better serve all of you. So thank you.
Yeah, absolutely. We've got some exciting news for you as well. I'd like to introduce you to Austin Mangold and Ronan Figueroa, the newest additions to the team. Austin and Ronan are associate advisors working with Matt and I in tandem to serve you. And they're currently working together to get their Series 65, as well as jumping right into the Certified Financial Planner training program right after that. So if you happen to notice that Austin and Ronan finish each other's sentences at times, it's no joke. These guys grew up going to kindergarten together. Then they attended La Costa Canyon High School before deciding to go to college at Cal Berkeley together. And if that wasn't enough, they even joined the same fraternity while in college. The two of them are inseparable, like peas and carrots, peanut butter and jelly. And of course, you all know the glue who holds the team together, Miss Jerry Hammonds. And she's joined by Matthew Awai, who many of you have already met as well. Matthew and Jerry form the operations team, and they can help you with just about anything. To name a few, they can help you get money into your portfolio or take money out of it, update a beneficiary, open a new account, schedule an appointment. They can also get you 1099 tax forms or copies of statements, as well as online access to view your accounts or to view the Seaside portal. Feel free to lean on them because Jerry and Matthew are highly trained and they've got the experience, which allows them to answer just about any question that you can throw at them. Whatever you need, Jerry and Matthew are here to help.
So during tonight's presentation, we're going to be covering a number of major themes that came out of 2023, including a market summary and performance update, inflation and the Federal Reserve, recession worries, the Magnificent Seven, international investing, a housing market update, and retirement and tax updates. All right, Brad, do you want to start us off?
Sure. I think a fair place to start to kick off the 2023 year in review, we got to go back to the beginning. We got to look at where 2023 started out. And as you remember, 2023 was ushered in. We were in the throes of a nasty bear market. And by definition, a bear market is a downturn of 20% or more from the previous high. In the average bear markets since World War II, we've seen a drawdown of about 33%, taking about 1 year to hit the bottom and more than a couple of years to recover. So those are just our averages right there. And this is the kind of thing that you should expect to happen maybe every 5 or 6 years. The The 2022-2023 bear market was right on schedule. Take a look at this. We had a downturn of about 25%, took about 9 months to hit the bottom. And now it's taken about 15 months to break even, and then about 24 months from peak to trough to back to peak to break even. So we've experienced 2 of these bear markets in 4 years, but that's how market averages work. You can't set your watch to these things. They're painful. They move really fast, but at some point in time, you blink and you get through it. But I think what was so painful about 2022 and its bear market is that it came right on the heels of the 2020 pandemic-induced bear market. So it's just back-to-back pain. So if you were feeling that at any point along the journey, you weren't alone. 2 bear markets in a 3-year span, that's a tough pill to swallow. And Matt and I get that. So that's kind of where 2023 started off the year. So let's change gears a little bit and talk about what actually induced that bear market of 22, which was inflation. And before we dive into that inflation, let's discuss the Fed and its role in the economy here as it's trying to fight inflation.
Great. So the Federal Reserve, they have a dual mandate: price stability and maximum employment. Prices haven't exactly been very stable these past few years, so it's no surprise inflation has been the main focus for Jerome Powell and his team. I'm sure the Fed wishes that they could just wave their magic wand and keep inflation rate and an unemployment rate at their target levels, but it's definitely not that easy. The Fed kept interest rates on the floor for most of the 2010s in hopes that they could push up the rate of inflation to boost the economic growth. So when inflation reared its ugly head in 2021, the Fed went on its most aggressive rate hiking cycle in history in hopes that they could push up the rate of unemployment to slow the pace of inflation and its economic growth. Jerome Powell basically said he wanted millions of people to lose their jobs. The Fed wants a higher unemployment rate and a slowing wage growth so the economy can cool and allow inflation to fall to a more normal level. The good news is that inflation has been slowing, but not because of the slowing labor market. So everyone's been calling for a recession for the last year and a half, right? In fact, this might be the most predicted recession that never actually really happened. So do you guys believe in miracles? Fed Chair Jerome Powell has been trying to navigate a soft landing and may have just pulled it off. Inflation is now down to 3.4% and trending lower. Meanwhile, unemployment has remained steady. Historically, inflation has never slowed more than 2% without unemployment rising. So the US economy has added nearly 6 million jobs in the last 2 years. The Fed wants to control inflation and the labor market, but it's harder than it sounds. It's difficult to control a $26 trillion economy, even when you have the ability to change the short-term interest rates. There's a good lesson to learn here for investors, though. The Federal Reserve is one of the most powerful financial bodies on the planet, and yet their policies have only a marginal impact on the 2 most important functions of their job. There are so many variables that are out of your control when it comes to investing in your future. So here are some of the things. Oh, go ahead, Brad.
No. I think you're making a great point.
Okay, I was going to say, so here are some of the things that you can't control. 1, what the Fed is going to do with interest rates. 2, what returns the markets are going to give you, how fast the economy is going to grow or when the next recession will hit, what tax rates will be in the future, and of course, we can't time bear markets or bull markets and everything in between. So you can always try harder as an investor and do more with your portfolio, but it doesn't guarantee you any better results. And Brad and I learned a long time ago that we can't use that G word. And in fact, most of the time when you're trying to be fancy with your investments, you tend to lead to worse results.
What's the G word, Matt?
I guarantee. No, there are no guarantees.
No guarantees. We can't even say that word.
Yeah, that's one of the hardest parts of investing.
Yeah.
The things that you'd like authority over are completely out of your control. But here are the things that you can control. You can have a financial plan in place. You can have your investment plan in place, the appropriate asset allocation, appropriate portfolio strategy, and of course, your risk profile and time horizon. These don't provide any 100% assurance for success, but it can help you along the way to be successful investors in the future. So
Yeah.
everything else is out of your control anyway.
Yeah, absolutely. It's such a great reminder. So let's break 2023 down by the numbers. Okay. There was 0 recessions. Let's start with that number, 0. Even though all experts anticipated there'd be at least one. There was 1 rating agency out of 3 that still has the US as a AAA rated credit country. 22.2% was the return for global stocks, highlighting a very strong year for equities. 26.3% was the return on the S&P 500 in 2023. The Magnificent Seven jumped by 76.3%, while the rest of the index gained just 13.7%. 5.25 to 5.5 was the Fed's policy rate reached in July as they worked to tame inflation, which was the highest level we'd seen since 2001. And that the Fed fund rate closed the year out in that same range. 3.1% was the November 2023 headline inflation figure, having fallen since it hit 9% during the summer of 2022. Think about that. We all remember inflation was 9% back in 2022. Now, 3.1 is a huge victory, although it's still above the Fed's 2% target that they're laying as their mandate. And then 4.98% is where the U.S. 10-year Treasury closed on October 19th, 2023. The last time it ended that high was in July of 2007, when it closed just north of 5. The 10-year Treasuries rallied at the end of the year, closing just below 4%, and now today they're hovering just slightly north of 4%. So here's some headline news that made it last year. So the U.S. added 517,000 jobs in January. Inflation started out last year at about 6.5%. And then U.S. QD the growth basically in Q3 was 4.9%. And then inflation drops to 3.1% in December, which was another huge victory. And then, of course, my favorite, Taylor Swift is Time Magazine's 2023 Person of the Year there in December of last year. And so go Travis Kelce, which I think brings up a good point there, Matt. Speaking of Taylor Swift and Travis Kelce, who are you rooting for in the Super Bowl, Chiefs or Niners?
I guess I'm the unpopular answer here. I'm going with Niners this year.
Hey, I'm with you. Brock Purdy, I like the story. I mean, Mahomes is awesome. Andy Reid's awesome. But I'd like to see some new blood. Chiefs have had a good run. Can't go wrong. But all right. I must say, though, I am very unpopular at home because I've got a 6 and an 8-year-old daughter who are rooting for Taylor's team. And you want to talk about Swifties. Those girls.
Well, so talking about Swifties, despite all the contradictory and confusing news, the equity markets went swiftly in the right direction.
Nice one, Matt.
Thanks. The U.S. market was up about 26%. International developed markets were up about 18%. Emerging markets up nearly 10%. And it's good to see the global real estate markets in recovery mode up a little over 10%. And then finally, after a tough 2 years, the bond markets in the US was up about 5.5%, and the global bonds outperformed at 8.32%.
Nice.
Yeah, and with the rate hikes that have occurred over the last 2 years, the bonds in your portfolio are actually positioned to benefit you, and last year was a great example of that. Also, I found something interesting on here. The best performing asset class over the last 20 years was emerging markets, which was compounding at 11.3% per year. What's interesting is the range of outcomes that you had to endure over this time frame. We see here that it was up as much as 78.5% and down as much as 53.3% in the last 20 years. While averaging 11.3% per year is a good thing long term, the volatility experienced over that time frame made it tough for people to hang in there over the long term. So that's where we come in to provide some much needed perspective on your investments and the portfolio, and in general as a way to help you rebalance through the volatility and minimize the risk while improving those returns.
It's so funny, Matt. I remember so clearly when emerging markets lost half of its value and people come in here going, oh, we're going to sell that thing, right? And I'm going, no, are you kidding me? Back the truck up, buy, baby, buy. This is the time to buy. The stock market is the only place that when the best things go on sale, people start selling them at fire sale prices. I still don't get it, but that's part of our job, is to just help coach and help maintain perspective and a level head. But yeah, you look at that down 53.3. That's no joke. That's a real number. We all would love to get that 11.3% long-term average. It does take some effort, some pain, some endurance to go through to get that. Yeah, for sure.
Absolutely. And then, so if we look at this slide here, the point of this slide is to just show you how wrong Wall Street pros are most of the time. Some of these guys actually still claim that their crystal ball works out. You all know on here that Brad and I lost ours years ago, but these guys still have it and they still get it wrong almost all of the time. So let's take a look at, and actually let's focus on 2023, which was no exception, as the Wall Street pros underestimated actual returns by 12%. It doesn't pay to try to predict or forecast the markets. It pays to stay invested through the markets in a globally diversified portfolio.
Yeah.
So more specifically, this chart looks at the exact same institutions we reviewed last year at this time. We didn't cherry pick anything on this. We just wanted to give you the update of their 2023 forecast with what actually occurred. So each of the firms showed had lower forecasts, but what actually occurred, from being off by 8% to being off by 22%. In other words, while forecasting makes an interesting debate and conversation, we wouldn't suggest basing your investments off of the forecast. So Jim Cramer better watch out for us.
Yeah, he's good entertainment, let's just say, good entertainment. But yeah, it's just so telling. I mean, look at JP Morgan, Bank of Goldman Sachs, Morgan Stanley. I mean, these are stout names on Wall Street. They're just dead wrong. And it's not like this is an anomaly. It's every single year. So this has become sort of a sport and hobby for Matt and I, is to see, well, how wrong are they going to get it this year? Because trying to base your investment philosophy on reading the tea leaves and predicting and forecasting the future, clearly the data says it does not work.
Now we make bets on how wrong they can be.
Yeah, right. I know. It's fun. All right. So speaking of making bets, holy cow, let's talk about the Magnificent Seven here for a minute. The Magnificent Seven, it seems to be getting a lot of buzz on the internet and everything else. So let's break it down. S&P 500 had a stellar 2023 return of 26.3%. However, the majority of that return came from just 7 stocks, now known as the Magnificent Seven, as they had a ridiculously strong 2023 with a combined return of 76.3% compared to just 13.7% for the rest of the index. And this is important because when investors see the return of the S&P, they should know that it's being driven by just a few names and not the broad market in general. Plus, when a stock rally is broad, the overall health of the market's considered to be better. So it's true that the Magnificent Seven stocks, I mean, you got Apple, Microsoft, Alphabet, the parent company for Google, Amazon, NVIDIA, Meta, Tesla. I mean, they're all great names, great companies. But they absolutely carried the market last year. What's mind-boggling is when you consider how big these companies have gotten. The average market cap for these 7 companies, average, is $1.6 trillion. The average market cap of the remaining stocks in the entire index is only 57 billion. So these companies are ginormous. So people are getting worried because what happens? They're wondering what happens if and when these huge stocks roll over and start to not perform well. And these 7 stocks make up close to 30% of the S&P 500 by market cap. Microsoft and Apple alone are nearly 15% of the index. And this is a legitimate concern. If these stocks crash for some reason, the market's going to fall as well. So it's also possible for other stocks in the index that they might make up for some of those losses, but it definitely highlights 2 really fundamental lessons to be a successful investor. Number one, you must remain globally diversified. As hard as it is to own many different asset classes with varying performance, it's crucial for long-term success. And number two, don't try and pick individual stocks. It's just way too hard. And you might get it right for a time, but to consistently pick individual stocks is darn near impossible. And so what's on everybody's mind right now is, will the winning ways of the Magnificent Seven continue? Can this outperformance continue? And so what this chart is showing is the historical outperformance of companies as they are growing in market share, just like the Magnificent Seven. Because guys, this isn't the first time that something like this has happened in the stock market. In fact, it seems to happen about every decade. There's new market leaders. And what you see here, the data tells us that in the 3 years before a company becoming the largest in the index, the outperformance is phenomenal. And the 5 years leading up to a company becoming a really large piece of the index, the 5-year performance is phenomenal. And of course, the 10 years before is phenomenal. So if we could all pick these companies ahead of time, if we could, forecast the future, we'd all be rich. We wouldn't be working. But what you see so clearly is that once these companies become the massive giants of the index, the performance afterwards is not so hot. So the following 3, 5, and 10-year performance numbers of these giant companies are all really, really poor. And there's some interesting reasons for this. Matt and I we're just kind of kicking around some ideas. We've done a ton of research on it. Some of the concepts are that these companies, just their sheer size starts to work against them. They used to be able to innovate on a dime and make change and change policy and change products and strategies. When they were small, they could do that. They were nimble. And once they get to be so big, it's kind of like turning the Titanic, just 1 degree at a time, and it gets harder to make change. That's one reason why. And the other is that investors have already piled a ton of cash into the companies, sending valuations sky high. And so we don't know when the tide's going to turn for the Magnificent Seven, but we know that at some point, the strong outperformance will subside, because after all, trees don't grow to the sky.
Yeah, you're absolutely right, Brad. And let's just take a trip down memory lane to prove our point just a little bit further. So in the 80s, nobody thought that there could ever be better companies than IBM or General Electric or Standard Oil. And then how about in the 90s with Philip Morris, Bristol Myers, and Coke actually cracking up into the top 10. And then, of course, there's companies like Pfizer and Bank of America and Citigroup becoming some of the largest leaders as well. And don't take us wrong, nothing against any of these companies, but you get our point. Nothing lasts forever. And this just highlights the importance of remaining diversified even when it doesn't feel good. So General Electric was the biggest company in the S&P 500 until 2005. The stock has been cut in half since then. The S&P is up nearly 400% in the same time frame. So GE didn't hold the market back by any means. So you're probably wondering, how is this possible? Well, let's take a look at NVIDIA, for example. It wasn't even in the top 10 list in 2005, 2010, 2015, or even in 2020. Yet, since 2005, this stock is up a staggering 13,000%. So the gains in the stock like NVIDIA more than made up for the losses in the stocks like GE. And exchange-traded funds ride the winners. And while they don't completely discard the losers right away, the stocks that are coming up pick up the slack for the eventual underperformers in those mutual funds or exchange-traded funds. And this is one of the reasons why we like using the ETFs.
Just pause on that for a minute, just like really unpack this. I feel like it takes the pressure off people. I think about that. You had one stock, General Electric, cut in half over a 15 to 18 year. Cut in half. That's scary. And another stock goes bananas. It's up 13,000%. That's a lot of pressure that, oh, wow, if I miss out on picking that one, I'm going to be hosed and I might have my retirement accounts cut in half. The great thing is that if you just simply own the ETF, you're up 400% in that time period. I mean, it does take the pressure off. And that's, again, another huge reason why we don't do individual stocks. There's just too much risk in doing it that way.
Yeah, great points. I love the idea of just having a basket of securities rather than owning one name. You get 500 names, and that spreads out that risk significantly. But clearly, the Magnificent Seven have been the big winners over the last 5 years, and it's caused the S&P 500 to be the #1 asset class. But this is very similar to the late 90s during the dot-com boom.
Yeah, eerily similar. And you all remember what happened in the decade ensuing following the late 90s. The S&P 500 lost 1% per year for an entire decade following the dot-com bubble. You'll also notice that other asset classes here, they're all positive, some a little bit, some a lot. But you'll notice that no other asset class on the board was negative during that same time period. And that's why we use typically 10 different asset classes in your portfolio at all times to defend against a lost decade scenario that could happen. And so that lost decade, it caused the S&P 500 over a 14-year period from 1999 to 2013 to compound at 4.68% per year, less than half of its long-term average for 14 years. And that's a scary thought, because when you look at someone who retired in 1999, right there at the peak of the dot-com bubble, and let's say they put all their money in the S&P 500, and let's say they took about 5% of it out per year, like a lot of retirees are prone to do. Guess what, Matt? They went back to work. They ran out of money in 2016. They went back to work in 2016. They're the Walmart greeter right now. They're the guy you see down there at the Walmart saying, "Hey, how's it going?" They got a job. And I don't know about you, but most clients that I work with don't have any plans on going back to work. Certainly not at Walmart. No offense to Walmart greeters, love them. But the point is, if you want a job in retirement, make it because you want a job, not because you have to have a job. And so the way to defend against having to go back to work in retirement is you've got to stay diversified, even when it's painful to do that. And the scary thing is the 2000 to 2009 time period is not the only time that we've had a lost decade. From 1928 to 1949, the S&P 500 was underwater. That's 21 years. That's a lot of time. And when you unpack the performance of the S&P 500 for 2023, you could see that 7 companies are up nearly 76%, while the other 4, so at one point in the year, those 493 companies were literally flat. Now, they rallied at the end of the year to close out. Those 493 were up 13%. But again, it just highlights that there's so much concentration in one index. It is concerning. So I'm not suggesting that we're heading for another lost decade in the S&P 500, because clearly my crystal ball is broken, as you've alluded to, just like the rest of Wall Street's. But it's just a really good reminder of why we have to maintain global diversification in the portfolio. So, so you've heard me say how important this is. I'm now going to remind you. I'm going to share with you some data and some interesting factoids about it too. But just because the S&P 500 has outperformed in recent times doesn't mean it was always this way. In fact, the S&P 500 and global stocks have taken turns for the last 50 years at market leadership. So in the 70s, international stocks outperformed the US. In the mid to late 80s, international stocks outperformed. And in the 2000 to 07, in that lost decade time period, international stocks outperformed. A couple of interesting factoids. You'll notice that international stocks over the last 2 years are starting to outperform. Now, it's not great numbers there, but this could be the beginning of the tide turning. And we've known for a long time that tide was going to turn, and this could be the very beginning of it. What I think makes this particular time period just so interesting, or even painful for some people, is that The recent US outperformance lasted for so long. It was 2008 to 2021. That's over a decade of US outperformance. And it's just easy to forget history when you get conditioned to the US outperforming. But I just laugh because it was in 2009 that it was following this time period right there where the international investments were red hot. US was ice cold. And I can't tell you how many people in 2009 said, Brad, we have got to sell out of every US investment we have. It's just dead. It's dead. It's a dog. I do not want to invest in the US. Could you imagine that today? I mean, look at this 13-year outperformance of 333%. Like, you look back and you realize, wow, that would have been really foolish. And at the time, I pounded the table and I said, no, you are not going to sell those US investments. And they all looked at me like I had a third eyeball on my forehead. And I said, it's not, my crystal ball was broken back then. I said, we don't know when the tide's going to turn. We just know that it will turn. And sure enough, it certainly did. And boy, did it have a run. And we're saying the same thing on the international side. That tide's going to turn. We don't know when. It might already be turning as we speak, but eventually it too will go on its run.
Well, and just like you said earlier, Brad, it's almost a perfect time for buying at a discount. Now, the international has been cheap for all these years.
Yeah, 100%. 100%. And so when you kind of expand the perspective a little bit over the last 50 years, the international stocks, if you owned a basket of companies, of ETFs that were both US and international, so we'll call it global, the outperformance is strong versus just owning a home-based investment portfolio. So the data tells us that over long time periods, international investing pays off. And but when you unpack it, people are asking me, so what has caused this recent US strong performance over the last 10 years? It's not what you think. It's not at all. It's not that the international companies aren't doing wonderful. It's that the US dollar is incredibly strong right now. So this is great if you like to travel. I've been saying this for a while. If you like to travel, get your trips in. Go, go, go. Because right now our dollar goes really far. Go to Australia, go to New Zealand, go to Europe, do the river cruises, do the things you guys like to do. Go to Hawaii, take the kids to Hawaii, take the grandkids to Hawaii. Go. I guess that's domestic. Never mind. Europe, Australia, you get my point. Travel internationally while the currency is strong, and it's wonderful for traveling. But over the last 10 years, the US dollar has gained 3.9% per year over foreign currency. So this has been good for you travelers, but here's what it does to the international investments. Denominated in its local currency over the last 3, 5, and 10 years, international investments have done quite nicely. They've done great in their local currencies. But when we're having to bring international profits home against a really strong dollar, it's chopping off those profits. It's reducing the profits. And so you can see that the reduction in performance is right here in the orange, and that's a real thing. So the actual performance of the international investments has been great, but because of this strengthening dollar, we haven't seen it on paper at home. And I believe that's about to change because you look at the amount of debt that the government is servicing right now. You look at interest rates being higher than they've been in 15 years. And those are both headwinds for the US dollar. That's going to cause the dollar to weaken at some point. And in most periods throughout time, you can see these are all time periods when the US dollar weakened. Purple circle here, that's the international investments. International investments tend to outperform US investments during periods of weakening dollar. In every single one but one, the international investments outperformed. And I believe we're heading into a time period. So get those trips in now, guys. Go, go, go while you can, because I do think the US dollar is going to weaken. And it's finally going to be the wind in the sails that we've been waiting for on the international investments. And Matt, this is exactly what you said just a moment ago. Valuations are cheap over on international companies. So, Matt, I'll ask you, would you rather buy a sweater from Nordstrom's for $200 or the same or very similar sweater from Bloomingdale's for $100. What would you rather do?
Well, if you know anything about me, $100 is a lot for a sweater either way, but I'm going for the cheaper one, of course.
Right. You're a bargain shopper. That's right. So it's the same thing when you're purchasing a stream of cash flows from great companies like Toyota, Nestle, Christian Dior, Volkswagen. These are great companies. And if you can purchase their stream of cash flows at a significant discount to their US counterparts, it's a good deal for you. And that's the macro environment that's been set up as of now. Plus, the performance of the international investments is much broader. So unlike the S&P 500, where the return is dominated by just a few stocks, international indexes are currently much more balanced and diversified. So if you held the largest 15 stocks in the Stoxx 600 fund, which is a representation of Europe, the year-to-date returns were double digits. So about 17 versus 15 for the entire index. So in other words, you're not seeing this really significant outperformance by just a few market dominators. So overall, this is just a sign of a more healthy stock market overseas right now. I love this slide. So this is just another great reminder of so here's the good old US of A. I love our home country, got the flag looking good. So a performance last year of the US was really good right here. But who would have guessed that in 2023, the number one performer was Hungary? Matt, were you guessing that back at the beginning of last year?
Oh, not at all.
I don't think Austin and Ronan were guessing that. And so Hungary outperforms the US. So does Poland, Greece, Egypt, Mexico outperforms the US, Peru, Italy, Taiwan. I mean, so you just never would have guessed that these countries would have outperformed the US. And it's just a very healthy reminder as to why it is important to maintain that global diversification. So backed by popular demand, this is our Skittles chart. And, a couple of interesting observations. Across the board, 2022 was just an awful year for stocks. You could see it. You could see it just really, really big negative numbers. And then 2023, fantastic year for stocks. And I think sometimes it's really healthy to see that back to back. It's not fun, believe me, but it's healthy to see it because you realize, okay, that's right. If I didn't panic in 2022, then I just hung in there, I got rewarded in 2023. But again, the point of this is that every single year you're going to have top performing asset classes here at the top, and you're going to have poor performing asset classes there at the bottom. And this white box here, you'll notice that this white box tends to always be somewhere in the middle. It's never in first place. It's never in last place. It's always somewhere right in the middle. And that is a typical retiree's portfolio, roughly 60% stocks, 40% bonds. Some retirees are a little bit more aggressive. Some are a little bit more conservative. Everybody has a customized portfolio that's unique to their needs. But this is a decent representation of what a retiree might be thinking about as they're heading into retirement. And you can see that this white box just cruised along there at north of 6% per year in a fairly tumultuous decade. And just true to form, it ended the decade here. The 10-year performance was not in first place, and it was not in last place. This is exactly what you want as a retiree, to be a consistent return of income here, and not be too high, not be too low. That's the goal. So you know how I feel about crystal balls. I think they're all broken. However, with where valuations are at today, the consensus is that international investments will do better than the US on the go forward. And nobody really knows to what magnitude, but you get my point. With international companies trading at deep discounts, this is a buying opportunity overseas. So we all know that we should buy low and sell high, but nobody does this very well. And now you know why. It's not always comfortable or easy to do it. And that's why you have us. We're going to help you maintain that discipline, not chase the shiny object or the hot performer, and find value and opportunity when and where it presents itself. It's simple, but it's not easy. So even, speaking of valuations and looking at international, even small cap stocks are cheaper relatively. They're more attractive as well too. Here's a look at valuations for both large caps and small and mid caps right now. And large caps are expensive. Small and mid are cheap. They're nearly as cheap as they were back during the COVID crash. And they're cheaper now than they were at any point during the 2010s. And of course, valuations don't guarantee investors anything, especially in the short run. But, the S&P has been expensive relative to small caps, international, and everything else now for years, and it hasn't mattered. But maybe fundamentals don't matter anymore, but that's not a bet I'm willing to make with my savings. Plus, you don't have to go back all that far to find a cycle when the roles were reversed and small caps absolutely dominated the large caps. So this is the investing fundamentals have not gone out the window. We still want to buy low, and we are seeing buying opportunities in small cap, mid cap, international, emerging markets. So just because people are talking about how expensive the market is, that's one component, one very isolated component. We would agree, very expensive. In fact, we've been selling that component off when we rebalance. That's what we've been trimming for now a few years. And anyways, I thought that might be insightful for you guys to see what goes on behind the scenes and kind of how we think about things.
Yeah, Brad, that was fantastic. Thanks for all the great information on the international investments. But what has been up with the housing market?
It's broken.
It's broken too, right? Well, heading into the pandemic, people thought that the housing market was going to crash.
Yeah.
And instead, housing prices fell a little less than 3%. And now they're right back to all-time highs. Housing prices went up 50% during the pandemic. Mortgage rates went from 3% up to 7%, seemingly overnight. So how could the housing market not crash? Not only have housing prices avoided a crash so far, but it's also possible that the mild correction in the prices might already be over as well. Part of the problem is everyone locked in a really low interest rate on their home, and they don't want to give that up. We might have seen some of the lowest interest rates in the last couple of years that we may never see in our lifetimes again. So good work for everyone that did that, but you're part of the problem here.
Yeah.
But so another factor is that in 2008, the financial crisis crushed home builders. Coming out of the Great Financial Recession, they didn't build enough homes. So inventory still remains low all the way around. People aren't selling their homes and builders aren't building. So that's what's keeping the prices propped up at the all-time highs right now.
Yeah. So let's take a look at the bond market. In 2020, government bonds went from risk-free to literally return-free as a result of the pandemic and the action taken by the Fed. Long-term bonds got absolutely hammered during the 2020 to 2022 cycle. And I'd say the good news on this, it was very painful to go through, but the good news is we positioned all of your bonds so they were really, really conservative. They were short-term and high quality, so they did not experience the drubbing that occurred in the long-term bond market. Your bonds did get hit, they just didn't get hit as hard. So now they're positioned to benefit from where rates are at because rates are much higher, as you see. So here's those yields today. So things are looking much better as far as rates go. We have the highest yield since 2007, basically across the yield curve. So this has been a 15-year cycle of low rates, and it's really nice to see that we're actually seeing yields at a kind of a decent place. So the good news is that on the go forward 10 years, your fixed income right now is positioned to really, really benefit from a much higher interest rate. And then last year, across all asset classes of the bond market, we saw positive returns everywhere. And in fact, international bonds outperformed everything across the board too, as a quick aside. So the 10-year treasury is currently north of 4% at the moment. Again, a great sign for the bond portion of your portfolio. All good signs for bonds. It's good to see when that happens.
It sounds like a lot of great news, Brad, but I do want to remind everybody that this is an election year, so clearly there's going to be some troubles ahead, right? Well, we're always looking for a competitive advantage for all of you with your investments. And so what we did is we studied the elections and its impact on your investments. And surely who is in charge of the White House must have a great impact on your investment portfolio. And what we found was that it really didn't matter who was in office. This chart showing you red or blue, the market did well despite who was in office. We broke it down a little further with recent performance of a variety of presidents, and the same held true. We had some winners, we had some losers, but over the long term, it really didn't matter as well. So what we wanted to do is we wanted to look into the data for who held control of Congress. And much to our surprise, probably similar to you, is we found the data still holds true. The market does well despite of who's in office. In fact, some of the returns that are the average returns during election year, we found that whether the new president or the incumbent president wins, the average returns during an election year is 11.3%. I don't know about all of you out there, Brad. I'm sure you're in the same boat as me, but I would take that every single day.
Yeah.
It's relieving to know. The point of this. It's relieving to know that our elected officials play a far less of a role in our investment returns than we think, especially with what the media is throwing at you all the time.
Yeah.
That is that their job is to scare you into reading, and so they can sell you on their investments. And remember, the media doesn't know your plan. They don't know your specific goals or your objectives. So just keep
Yeah.
that in mind when you're seeing these things.
It's so true, Matt. I mean, the thing you were saying earlier about the Fed, you'd see, yeah, I just don't know if it's. I guess it's social media or just what we read, but you feel like, oh, the Fed has all this control, or right now it's an election year and our politicians have all this control. At least that's what I think the media wants you to feel. And when you study the data, you just see that it's not true.
And
And,
I'm not saying that the volatility won't be
yeah.
there. I mean, with uncertainties that are coming, the markets do move quickly in that
Yep.
short term. But over those long terms, it is very predictable. And typically, as our history has shown, that these years are usually really good.
Absolutely. Absolutely. And I think it's a great reminder. You think about companies are out there, their whole existence is to return a profit to shareholders. And so no matter who wins the election, they're trying to figure out how can they benefit shareholders.
Of course. And so that, I mean, that's a great point. This slide here, what you should focus on, I know it's hard at some of the times, is the long term, and the stock market has always gone up over the long term. I view it as a way to invest in innovation, profits, progress, and people waking up in the morning looking to better their current situation. While I love the fact that this chart illustrates my long-term philosophy, it is a little bit misleading. And what I mean by that is that the stock market does go up over the long run, but it can get crushed in the short term, just like we just said. And it can be difficult to see on this chart. It's over 200 years of data. But things like the Great Depression, the 1987 crash, the Great Financial Crisis look like minor blips on this chart. And while every crash eventually turns into a blip on the long-term chart, they don't always feel like it at the moment. Looking at this chart got me thinking about other ways to visualize of how markets actually work. So let's take a look at a few others. So you can enjoy the good returns over the long term without going through the downturns along the way. And so here's what those blips look like in the short term. The Great Depression was not a blip. It was a tsunami.
Yeah.
People thought the 1987 crash was going to lead to a depression. The financial system was teetering on the brink of extinction in 2008. And sometimes the stock market does crash and it takes longer to get your money back, but that's why it's important to be patient and just stick to that diversified portfolio that does work over time. Another favorite chart of mine, and this one might help explain the stock market, is by looking at the annual returns matched up with the intra-year downturns. So the average intra-year peak to trough downturn since 1928 was negative 16.4%. So losses in the stock market should be expected. When you're breaking it down year by year, you see most of the years are positive, and that's a good thing, but you do have to endure that pain along the way. And that's what these orange dots are. They're the low points in any given year. And although successful investors get great returns over the long term, like we just said, you have to endure that small pain along the way. And again, this is part of our job to help navigate through all market environments with you to make sure that you are one of those successful investors. The good news is that being patient, and if you hang in there over the long term, you will experience the positive returns most of the time. In fact, there's never been a 20-year time horizon where the markets were not positive. And I know most of you on this webinar have at least 20 years in you, if not a few of those 20 years in you.
I sure hope so. I hope a few of them.
And I mean, as you all know, most of you in your financial plans, we're assuming that you're living until age 100. So there's a chance that you have, 20, 30, 40 years in retirement. So where I'm going with it is that you do have a long time horizon.
Yeah. 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 That's such great perspective. That's such great perspective. Well, hey, look, this is a fan favorite, Matt. You've heard me say that my crystal ball broke years ago, but we'll love it when we do this. They want to know our top 10 predictions for 2024.
We've got some good ones for you this year.
Yeah, we do. We do. And unlike Wall Street forecasters, we think we're going to get them all right. Are you ready for this?
Let's go.
All right. The number one prediction, there will be an election this year. We predict that an election is coming. That was a good one, right?
Oh, yeah.
We also predict emotions will run sky high.
Always.
Yep. And we think that a lot of people are going to be unhappy with the economy, the markets, and the election results, no matter what happens. You can't please them all. You can't.
Yeah.
The market cares a whole lot less about who wins that election than you think it does. So we're gonna predict that the market is not caring as much as we think it does about the winner of this election. Not everything in your portfolio is going to work in 2024. It's just a fact. The Chargers won't win the Super Bowl. Well, wait a minute. Wait a minute. With Harbaugh at the helm, you're saying there's a chance. You're saying there's a chance. I thought that was just a great hire. They broke my heart. They stabbed me in the heart when they left to LA. But man, if there ever was a chance of the Chargers winning again, I think they got the right guy. If they can't win with him at the helm, they should just leave. So this is a fact. I probably won't skydive with Matt this year. That is
one of these years, maybe.
Yeah, no, this year is not the year. But Austin and Ronan might. You gonna get him out there, Matt?
Oh, if they're in, I'm in.
Okay. The markets will go up. The markets will go down, and not necessarily in that order. That's just how it works. And then this is my favorite one, the last one. Jerry's son, Grant Hammonds, will hit a grand slam in 2024. Matt, I think, wait a minute. He already did back in January. Grand slam, bases loaded, first tournament of the year, and Grant puts one over the fence. And I think they might have even won the game on that one. So way to go, Grant. We're proud of you, buddy. Good job. So anyways, so with all kidding and funning aside here, let's kind of bring this thing to a close here, and let's focus on the things that really matter when it comes to a successful investment experience. Financial planning is a process and not an event or an endpoint. You got to concentrate on your long-term goals and objectives. You got to focus on reaching goals, not on beating benchmarks. You have to maintain a disciplined approach in good and bad markets. And you need to invest broadly and globally because asset allocation is key. You got to reduce investment and tax costs anywhere possible. And you have to rebalance as needed. So important to rebalance. So this concludes our 2023 year in review event. And we want to thank you for watching. And at this point, we're going to turn it over to some question and answer session. And this is sometimes our favorite point of the section here, because some of the questions that come up are great. So if you've been submitting questions along the way, we'll go ahead and get to those.
got one, Brad, for you. When do you anticipate the first rate cut?
That's a great question. So I know the Fed meets in March, and that was the most talked about thing. Is when is will they do it in March? And there was a day a couple days ago that the market went down because it was thinking, oh, maybe it won't cut. Um, Powell seemed to indicate that he wasn't planning to cut in March. So based on kind of reading the tea leaves, it sounds like they're not going to in March, but who knows? Maybe it's going to be later in the spring. I think they're still looking at the data numbers just to make sure that they can actually take their foot off the brakes. So that's a tough call.
Yeah.
Yeah. Here's one. So with international being on sale, I like buying sweaters cheap. Should we should we be putting more money in the international investments than we normally do?
Are you asking, should want me to take that one?
Yeah, sure. You want to take that one?
So the answer is no. We still want to stay disciplined to our investment philosophy, and that's another way of trying to time the market. And so really, we just want to stay within the appropriate asset allocation and then rebalance through the markets in real time to. And so yeah, let's not add more than what we're already having as part of the portfolio.
Yeah. Yeah, good. Yeah, good answer. Um, okay. Any other questions here?
Um, I'm not seeing any come in here. I said, oh, we got a comment just there. Thanks for the recap, reminders, education, and terrific management of investments.
Uh, Here's a good comment from Ralph. Trees might not grow to the sky. However, clouds, in quotation, float over trees. And Amazon, Google, and Azure own the IT cloud space and will continue to fly high. That's good. That's good. That's good. You know, it's interesting. I think back to the 80s about the slide you were talking about, Matt, the IBMs, the AT&Ts, the dominant players. And yeah, you're right, Ralph. It's so hard to imagine these solid companies today not dominating forever. But I do think that's what people must have thought about the Nifty 50, as they called them back in the 60s, or companies like IBM back in the 80s. At some point in time, I do believe that's the great thing about capitalism is it's constantly rewarding innovation and progress and improvement. And there are going to be companies that are coming up the ranks. We don't know who, we don't know when. And it's nice to know that it takes the pressure off that you don't have to pick the individual winners ahead of time. You can just own a basket and let them all battle it out. And then we get to benefit from progress in our everyday lives, but we also get to benefit financially because ETFs, exchange traded funds, help us to own the collective basket of all the companies that are doing great things. So I think there's never been a better time to be an investor. As brutal and tough as it is at times, I think we're living in a golden age where technology is just incredible. The ease of investing is I think the tools that we have, Matt, at our disposal to do our jobs have never been better, to serve people better.
Mhm.
So I think this is just a really good age.
And it looks like we got one more. I can take it. It says, any comments on virtual currency? Continue to stay away or invest a little bit. So yeah, now that there's ETFs for things like Bitcoin, some people have questions of, is now the time to get into it? Our philosophy is still to stay away from the digital currencies, even with the ETFs. The reason being is these things, they don't produce any goods or services. It's hard to put a value on these. I mean, think of like your Apple phone or going to the grocery store. People are going to always have to buy their diapers for their kids. It's easy to put values on companies, the great companies around the world. So for now, and then another thing, we kind of put the digital currency in the basket of commodities. And as you saw earlier on the Skittles chart, commodities have just been a drag on portfolios for a
Yeah.
number of years. And even if we put anything, there's a lot of risk in digital currency, so it'd be a small percentage. I'd rather use that small percentage to be spread out between the great companies around the world. So if you want to, I would say a little bit, do it on the own, but make sure that you can withstand losing 100% of those assets as part of your plan.
Yeah. 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 Good feedback. Well, with that, looks like we are out of questions. Guys, it was truly a pleasure to put this on for you. A couple of housekeeping things. We are doing it's becoming a new annual tradition. We like to call it the wind down the tax season. It's going to be on, what is it, Matthew, April 17th? It's right around the tax deadline. Details coming out soon. We've hired a shred truck. So bring your piles of paper that need to be shred. Come join us for some wine, some appetizers, some charcuterie, some laughs. Bring your tax return so we can scan it and officially kick off the start of tax planning season. And come and enjoy a drink with us and get all of your housekeeping, your shredding taken care of too. So that'll be right around tax deadline this year. Look for details coming out. And then we're also going to be hosting an event in the fall. It's going to be an educational event on long-term care insurance. What is it? Do you need it? How do you get it? How much does it cost? So all those sorts of things. We don't sell long-term care insurance, but we're bringing in some experts to educate you. We've just gotten a lot of questions around that. And then lastly, a big push this year for our clients is we're really taking our estate planning to a deeper level. So many of you have been noticing the emails. If we don't have a copy of your will, we've been asking for it. If you guys get a chance to just upload copies of your trust and or your will or both, if you haven't done so already, to the Seaside portal, that would be a real benefit to us. We've been trying to track them down just so we can serve you better and really help on the estate planning piece. So with that, Matt and I, it is just a pleasure to serve you on this journey. We love what we do. We love working with you guys. We're so excited you get to meet our growing team. We're continuing to grow. We're continuing to hire great people. I'm really excited for you to meet Austin and Ronan if you haven't, and to really get to know Matthew more on his career journey. He's a great guy. And anyways, it's a pleasure to be with you on this journey.